Chapter 6 focuses on revenue recognition. For many companies, revenue can be the single largest item that's shown on the financial statement. Thus, determining how much to record and when to record becomes pretty important. Revenues are defined as inflows or other enhancements of assets or settlements of liabilities from providing goods and services that constitute an entity's ongoing major or central operations. And that last part distinguishes them from things like gains. In simpler terms, we can think of revenue as inflow of cash or accounts receivable that a business receives in exchange for providing goods and services to its customers. In recent years, revenue recognition principles have changed. The prior revenue recognition principles, prior to the effective date of December 15, 2017, indicates that revenue is recognized in relation to the realization principle. The realization principle required revenue to be recognized when it was earned and when it was reasonably certain that we would collect the asset or cash. But there were several problems with this realization principle. Some of the main ones were that it was poorly tied to FASB's conceptual framework, which focuses on the balance sheet, whereas the realization principle focused on the income statement. Additionally, the focus on earnings in this manner led to certain transactions being treated differently across different industries. And so because of this, a new revenue recognition principle was developed in 2014 and became effective in 2017. This new standard was ASU 2014-9, Revenue from Contracts with Customers. It overwrote 200 different pieces of specialized guidance that related to revenue recognition. The core principle of this new standard indicates that companies recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods or services. This core principle helps standard implementers answer questions like when should revenue be recognized and how much revenue should be recognized. There are 5 basic steps to recognizing this revenue. The first is to identify a contract. This contract can be written or it can be implicit or oral. The next step is to identify the performance obligations within the contract, what goods and services are required by the seller. The next step should be to determine a transaction price for the contract, and then that transaction price in the fourth step should be allocated among the various performance obligations. When there's only a single performance obligation, this becomes pretty straightforward. The transaction price is associated with one thing. But when there's multiple performance obligations, for instance, a service and a product might be involved in a single contract, then you must allocate the transaction price among those various different performance obligations. And finally, you then recognize revenue based upon when the performance obligation is satisfied. These are the 5 basic steps associated with the new revenue recognition principle. This diagram highlights key considerations for each one of the 5 steps. The first step, identify the contract. The contract should establish legal rights of seller and customer. In the second step, it's important to note that you could have a single performance obligation or multiple performance obligations in a single contract. And if you have a single performance obligation, there's no allocation necessary for the transaction price. But if you have multiple performance obligations within a single contract, you must allocate a portion of the transaction price to each performance obligation. The transaction price itself represents the amount that the seller is entitled to receive from the customer. And finally, in recognition of revenue, it's important to note that we recognize revenue when performance obligations have transferred the promised good or service to the customer. And we consider transfer to have occurred when the customer has control of the good or service. That can happen at a point in time or over a period of time. And we'll look at each different situation and when we should recognize revenue for those 2 considerations. Note that when we have multiple performance obligations, we recognize revenue at whatever time is appropriate for each performance obligation, again, considering the at and point in time scenario or the over a period of time scenario. As stated a moment ago, the seller recognizes revenue when it satisfies a performance obligation by transferring the promised good or service, and we consider transfer to have occurred when the customer has control of the good or service. We use indicators to determine when control has transferred from seller to customer. A customer is more likely to have control if it has an obligation to pay the seller, if legal title or ownership of the asset has transferred, if physical possession of the asset is now with the customer, if the customer has assumed the risks and rewards of ownership. For instance, if the asset is damaged, it takes the risk then of that ownership, and the customer has accepted the asset. All of this would indicate that control has passed. And you must take into consideration these both individually as well as collectively to try to determine whether or not revenue should be recognized. In looking at an example of whether or not revenue is recognized at a single point in time, take into consideration TrueTech Industries, which sells the TriBox, a gaming console that allows users to play video games individually or in multiplayer environments over the internet. A TriBox is only a gaming module and includes no other goods or services. When should TrueTech recognize revenue for the following sale of 1,000 TriBoxes to CompuStores? Well, they give us information, it's a cutoff a little bit here, but they give us information that says on December 20th, 2017, CompuStores orders 1,000 TriBoxes at a price of $240 for each console. That delivery of the consoles is supposed to take place in 30 days. As of December 20th, 2017, there's no entry because all we have is an order. No transfer of control of the TriBoxes or exchange of cash has taken place. Thus, no journal entry takes place. However, on January 1st, TrueTech, the company that's the seller, delivers 1,000 TriBoxes to CompuStores. Now that CompuStores has title, now that CompuStores has accepted the goods, now that CompuStores has the risks and rewards of the asset, we can now, as TrueTech, recognize revenue. So we credit sales revenue and debit accounts receivable for the cash that we're expected to receive. On January 25th, it says that TrueTech receives the cash owed from CompuStores, and there we debit cash and credit accounts receivable. Notice revenue isn't impacted at this. This is just sort of the fulfilling of the cash component for the performance obligation, but this does not impact actual revenue. This was an example of fulfilling our performance obligation at a single point in time. We also can recognize revenue over a period of time. In order to recognize revenue over a period of time, one of the following three conditions have to be present. The first condition is that the customer consumes the benefit of the seller's work as it is performed. An example would be we receive a service like a cleaning service, and we receive the benefit as that service is being performed. The next example would be the customer controls the asset as it's created. For instance, if there's construction for a building, we control that asset because the building's being built for us. The next is the seller is creating an asset that has no alternative use. An example like this would be, for instance, something's customized for the U.S. Air Force, like fighter jets or Navy ships or something like that, where we have a situation where this is a customized asset where the seller has no alternative use and has legal right to receive payment because they're building this customized asset. If any one of these three circumstances are present, we would recognize revenue over a period of time. If none of them are present, we would recognize revenue at a point in time. Here's an example for recognizing revenue over a period of time. Again, go back to TrueTech Industries, and instead, this time they sell a 1-year subscription to the TriNet multi-user platform, which is an internet platform where you can play games. TrueTech sells 1,000 subscriptions for $60 each on January 1st, 2018. Notice that this is a 1-year subscription. So over that period of time, over that year, revenue is going to be recognized as the benefits are consumed. In the January 1st journal entry, when we initially, as the seller, received cash, our journal entry is to debit cash and credit deferred revenue because we have not yet fulfilled our performance obligation. However, over time, as 12 months pass, we will periodically debit deferred revenue and credit service revenue to recognize our portion of fulfilling the performance obligation as the benefits are consumed by the customer. So the total amount was $60,000 that we had. We divide that by 12, and that produces $5,000 per month that we recognize as revenue as we provide the performance obligation to the customers. At the end of those 12 months, we should have 0 in deferred revenue and $60,000 in service revenue. If the performance obligation does not meet any of the 3 criteria that we just mentioned above, right over here, these 3 conditions here, then we would recognize revenue at a point in time, as I mentioned earlier. And that would usually occur at the end of the contract. Keep in mind that if we're recognizing revenue over a period of time, we have to have a way to measure our progress towards completion. There are 2 general ways in which we can do that: output-based estimates and input-based estimates. Output-based estimates measure as a proportion of the goods or services transferred to date. So for instance, in our last example, we looked at time. If we were, for instance, building roads, we could look at the miles of road that we built in comparison to the total miles we expect to build. That would be an output-based estimate. Input-based estimates measure as a proportion the effort expended so far in relativity to the total effort expected. Examples of this are, for instance, the costs that we've spent so far in comparison to the total cost that we expect to spend. We often consider that to be a cost-to-cost ratio. And we'll look at that as closer as we get to the end of the chapter and we start looking at construction projects and how we recognize revenue and measure our progress towards completion in those types of instances.